Okay, well, welcome back, everybody. Glad to see you again. Couple familiar faces from before. Glad to see you guys. Last time, we did our general stuff, introductions, and kind of got introduced to what we were going to be talking about. One thing I didn't quite go over is our little disclosure that we have to put out there. So we're just going to read this really quick. So this seminar is being presented for educational purposes, and it's not intended to take the place of specific financial advice. What's right for one person will not be appropriate for the next. You're encouraged to seek professional advice in the areas of investing and retirement plans, insurance, taxes, banking, real estate, et cetera, all the good stuff. A lot of the things, many of the statements given throughout the class are opinion and shouldn't be construed as recommendations for any specific security or investment strategy. So anything that I'm saying is a general concept that you need to learn how to apply yourself. I can say something that might be suitable for one person, but it's very unlikely that it's going to be suitable for the person next to you. So it's very important that you take your own goals and objectives and suitability, sophistication, all of these sort of things into account when you're choosing products or creating a plan for yourself. Very important that it's for you and not just for the next person. When reviewing historical performance of various investments, keep in mind that past results are not an indication or guarantee of future performance. So something that we're going to talk about a little bit later once we get into specific investments and how to construct a portfolio is we'll talk about things like standard deviation, like an average return that we've seen over a historical period of time. That's not a guarantee that over any period it's going to do the exact same thing. A lot of these numbers are averages, and it's just historical volatility being brought down into numbers that we can present easily. It doesn't mean that it's going to behave in the exact same way moving forward. It's only maybe a statistical probability that we can assume may be good for our uses, but it's not a guarantee. There is no indication of what's going to happen next. Always read a current prospectus before investing. So if you're buying a mutual fund, if you're buying some sort of product, read the prospectus. It will give you all of the information of what they do, how that investment works, and how it's going to be suitable for you. That's going to have every bit of information that you could possibly need. Due to the constraints and varying degrees of student knowledge, some topics may be covered in some simplified terms. So we encourage you to refer to the book, Active Retirement Investing, The Process, for more detailed information and discussion of possible risks with specific investment products, and also do your own research outside of us too. We have our own biases towards what we like the best, and there might be something that we almost would never recommend that may be suitable for you. It's possible. Like, for example, we're not big fans of annuities. They end up being really expensive. You don't really get too much benefit other than it's all sort of packaged in one place. That's what you want. Great. If you've got the money to spend, fine. It's not something I'll ever really recommend to a client, except for maybe a fixed annuity one time for a one-off, but it's possible that you may find that it's the most suitable product for you. So do your own research even outside of us too. I like to think that we're experts in our field, but there's always going to be more information out there that could be useful to you. So feel free to always look around. Contact these regulatory agencies below to find out information about the responsibilities and role of broker-dealers, registered investment advisors, and the representatives. So you'll have the Financial Industry Regulatory Authority, FINRA. That's one of the big dogs that watches out over us. And then if you want to check on us or anybody else, brokercheck.finra.org, or just Google search BrokerCheck, and you'll be able to look at our history, see if we have any complaints filed against us, and what sort of licensing that we have. And then, of course, the big one that everybody knows, the Securities and Exchange Commission. Those would be the people that sue us if we do you wrong. So by remaining in class, you acknowledge that you've read this disclosure and understand the content. And if you want any clarification of any of this, or if you even want to come in and have a free evaluation, not trying to solicit any business, just trying to guide you on the right path, you can call us at 916-863-1266. And we've got business cards up in the front if you want to take them. So one of the things that you should have received in your email at some point, and if you didn't, we'll send it again. We talked about Bloomberg as one of the places that you could look at some financial news, as well as Morningstar as another place that we can look. So let me pull this up really quick. I'll just give you a little bit of a preview of what you could be looking at. So this is Bloomberg. This is where I like to go if I'm just looking to read a couple articles on what's happening. You can see a couple important things like their markets wrap, so that's a little bit of their discussion about the markets. You'll have some stories about things that are happening, like the Trump media shares is going up by 11% after he said that he wouldn't sell. always interesting to see what's going on there within those. But one of the other places that I like to look, oh yes. So there are some things that you need to subscribe to, but I believe there are some articles that you can read for free, but this is a subscription. I don't remember exactly how much it is, but it's not too expensive. But you can find a lot of similar topics that are covered on here on places like CNBC, MSNBC. All your big news outlets will usually cover a lot of the similar stuff. But this is just good to have it all kind of in the same place and about the same topics. That's why I like these. Morningstar is also a great one. This is one of our top places for research. I do a lot of my research on Morningstar, not because I think their opinions are the best, but because I think they organize data in a really helpful way. So I really like looking up different mutual funds, ETFs on here, and they've also got some great opinion pieces as well. Stuff like what falling interest rates may mean for the 60-40 portfolio. That's a conversation that's been had several times over the last decade or so when interest rates completely flatlined for a little while there. And basically we were saying the 60-40 was dead. And there was almost no point to having bonds because what were they even doing for you? And if interest rates went up, they would have been just as volatile as the stocks anyway. So that's something to sort of think about, and a couple of the things that you can research here. Can you save too much in an HSA? A bunch of little opinion pieces that can be really helpful for you to see. And then obviously I really like all of their tools for looking up ETFs and mutual funds and all sorts of things. And we'll dive a little bit more into the more technical and specific stuff later. But for now, let's move on with the class. I'm just going to throw up the emergency information here one more time, just in case anybody missed it. If you want to get that down, just in case you need any of these numbers to contact anything, if anything happens, and if I or any of our helpers are not able to do so. So today, we're going to get a little bit more into what you do for phase one of the financial planning process. Like we talked about before, that's kind of where we're looking at your finances, looking at your goals, evaluating where we are, evaluating what we want to do. For some people, it's really simple. There's not a lot to do here. For some people, it's really complex. And usually the people it's complex for are the people who just haven't really sat down and done any of this. A lot of you will have done your budgets already. You will have already looked at all of your insurance coverages. You will have already thought about estate planning, even in a really simple way. But there's a lot of people that they don't really think about it until they're really getting to the end there. And now we need to put all this work on their plate at the same time. And some people, unfortunately, don't really do anything even until afterwards. And now the family's left to kind of pick up all the pieces and put it together. So we've got our 3 phases of financial planning: our basic financial planning, investment portfolio construction, and post-planning maintenance, like we mentioned before. And now we're just going to dive a little bit into the basic financial planning. Phase 1 will consist of what we call diagnostics. I've described this a little bit before, but I'll go over it again. They're really just kind of taking these big processes that you can do that can get really complex and boiling them down into more simple ways, more simple documents that you can just kind of hit on the major pain points to make sure that you're at least somewhat within line, even if you're not detailing every single penny and making sure every little teeny tiny thing is accounted for. We're at least going to cover the big things that would be a big risk to you. So first of all is with your cash flow. It's really important to be able to analyze and project your money in and your money out, because without knowing how your money is spent, how your money is earned, it's really difficult for us to be able to plan for that in terms of investments, other income planning, insurance planning, and things like that. We need to know where your risks lie. So if one of your risks is just simply going to be outspending your assets in retirement, it's going to be really important that we know that so that we can plan for it in the future. Because I was actually just recently meeting, I think I talked about this last time, but I was just recently meeting with some prospective clients or existing clients, and they just didn't really know what their expenses were. They didn't know what their expenses were going to be, and they were asking me to do income planning for them. And I just kind of told them, like, I can't really plan for what this lump sum of money is going to do if you don't know how much you're going to need. And then they just threw out a big number, and I was like, okay, you know what? I'm going to send you a worksheet. You'll come back to me when you have this filled out. So Without proper expectation, we can't create a proper plan. That's going to be true in every single area of planning that we're doing today. If you can't put your brain power down and get this information together and have these hard numbers, I can't do the math. We can't move forward with a plan that actually will give you a reasonable chance of success. With concrete numbers, we can more easily calculate needed assets. And there's a couple, we'll run through how we do that. I won't show you the exact calculations, but I'll kind of run you through the idea. But there's a lot of stuff that we can do to basically come up with the lump sum numbers that we need in order to satisfy your income needs. Or we can tell you how long are your assets going to last with a certain amount of withdrawal rate, assuming a certain amount of return, and all sorts of things. So most of you should already have a good grasp on your budget. If you don't, tisk, please get on it. However, knowing the specifics can make the rest of planning easier. So, you know, it's just little things like knowing what your discretionary spending is like and knowing how it's going to increase if you decide to want to do more fun stuff in retirement. Because a lot of planning tends to assume that your spending is going to be less, but you never know. Some people really got that travel bug and they really want to get out there. And there's nothing wrong with that. I advocate for clients spending their assets. There's a point to having them in the first place. But it's really important to kind of know and project roughly what you think you're going to be doing. Because if you are planning all-in inclusive experience with maybe motel on the side of the street money, it's just not really going to work out, and you're not going to be able to take as many different vacations as you think you are, and then you'll end up in the position where your assets stop being able to cover your income needs. And that's just not where we want to be. So making a list of income sources is really important. You might have wages, you might still be working, you might be self-employed or have some contract work that you're doing, you may be getting Social Security payments, you may have a pension, you may even be getting annuity payments or be taking required minimum distributions from your IRAs or 401ks, or just be taking distributions out of something like an inherited trust, for example. So it's important to understand where all of your money comes from. Also, for one, so that we know where it comes from, how we know it's taxed, but also so we know what amount is going to ever stop. So if we know that, say, our employment income is going to stop, it's really important we know exactly how much that is, so I know how to make up for it. If you have maybe an annuity that's a period certain and it's not a lifetime payment or something like that, then we got to know when that ends. If you have investment distributions that maybe haven't even started yet, so we know our income is going to go up by a little bit. It's important to know that. Make a list of your current expenses. A couple common ones: your mortgage, healthcare, groceries, all of the normal stuff that you're going to pay on a month-to-month basis. It's good stuff that you probably already are very aware of, but just knowing how it all totals up, very important. And also knowing what may go up, what may go down, all sorts of stuff. All your insurances, leisure activities. Like I said, it's important to understand your leisure spending and your discretionary spending. If you're a shopaholic, that's fine. Just make a budget for it. It's okay. I get it. It's fun, but you just got to know what that's going to look like so that we can plan for it. There's a lot of different lifestyles that can be accommodated for if we just know in advance what we're planning for. So one of the things that you will see up here and was also hopefully passed out to you would be an income and expenses budget sheet that we just created in our office. So we created this with the purpose of helping our clients do income planning. It was really created for that client pair that I talked about earlier, where they didn't really know what their expenses were. They didn't know really what they were going to be. So we decided we were going to come up with this document that we can pass out to our clients and we can have people fill out. After the class, you'll get this in your email in a PDF format that you can fill out on your computer if you want to, if you don't want to write all this down. It'll automatically total up all of the stuff on your budget so that you get your total numbers. But a document like this is really helpful to have, especially so that you can have it documented and you can have it set aside. I personally have my own version of this. I have my own spreadsheet that I've created for my own personal uses that I am basically checking on every single day, making sure all my numbers line up and knowing exactly what my life costs. And so that makes me very hyper aware of how everything's going. And it gives me a lot of confidence moving forward every single day. So you'll have that, you'll get the digital version in your email, but this will include a lot of different things. You can even, in the PDF version, there will be drop downs so that you can select your tax bracket. Let me bring this up. So if I go over here and I go to this. So all of the information that you can total up, maybe you say you've got a little bit of income there, a little bit of income there, but you'll see it automatically will add it here on this portion. And then also if you scroll down, we've got the effective federal and state tax brackets. So if you know your effective rate, you can grab the drop down and put this information in there just so that we can be aware if you're submitting it to us or if you have it in your records. So for future expense planning, it's very important that based upon your age, health, pension size, and all these other factors, that you see how much income and expenses you're going to have for the future as well. Current numbers are great, but things change. Obviously, things change. Life changes. There's going to be things that change in your life that you want to account for, especially monetarily like this, so that we can make the proper plan moving forward. So using some basic financial calculators, we can solve for a bunch of different things. Now, I'm not going to whip out my calculator and start clicking buttons in front of you all class, but we'll go through kind of the idea of how all this comes about. And if you ever want to do calculations like this, you can simply Google search financial calculator, time value of money calculator, things like that. Or I can run a couple calculations for you as well. But a few of the things that we can get is we can find out what kind of current capital you might need to satisfy an objective. So if we know, for example, how much we want it to pay out per year, we know how long we want it to last, we roughly understand what our investments return is going to be expected to be, and we have an idea of how much we want left at the end of the period, we can figure out roughly how much capital are you going to need today to satisfy all of that. It may be a lot more than you think. So we'll have a couple pre-calculated examples here that we can show. So for example, if somebody wants to generate a $50,000 income stream, $50,000 of income every single year, whether that's from dividends or interest or capital gains, what have you. We want to generate $50,000 a year for 20 years. So that means over 20-year period, every single year we're taking out $50,000, and that's paying for life expenses, whatever the case may be. We're assuming that they can earn 7%. Now, keep in mind, this doesn't mean that every single year you're going to get 7% on the dot. That's just not how investing is going to work. Some years are going to be up 25, some are going to be down 15, some are going to be really bad, some are going to be really good, and some are going to be straight flat. But with average numbers over a long period of time, we can somewhat trust the conservative estimate of what our investments have done in the past. So we're assuming that it's going to be 7% flat in this calculated example, which is usually why I'll back down off of what the portfolio has experienced or what we think it's going to. But at the end of the 20 years, we're assuming it's down to zero. No inheritance for beneficiaries, nothing like that. We just want to spend it all the way down, but I want that $50,000. If we're able to get 7% every single year, highly unlikely, but assuming that we are, this investor would need $530,000 starting on day one, and that's returning 7% every single year in perpetuity until the assets are depleted. Now that would give us our income stream. Now let's say the investor wants to generate $530,000 in 10 years. Say we've got 10 years from now until then, and we want to satisfy that income need for the next 20. Now, if we're starting with a $150,000 portfolio, we would need to generate a return of 13.5% every single year over those 10 years in order to make it to $530,000. So what that tells us is we're probably going to need to make some contributions, hopefully some aggressive ones, because I don't know a lot of mutual funds or even the S&P 500 that is continuously getting 13.5% every single year in perpetuity. Usually there's some ups and downs, and pretty significant ones at that. The other thing to think about with these calculations is, again, like I mentioned, these are assuming the same return year over year forever. However, as we'll discuss a little bit more when we get into portfolio construction, I want volatility to be lower the closer we get to the end of the period where we need the money. I don't want to be at the last year completely invested in the S&P 500 or the NASDAQ, because what happens if we had what we just had a little bit ago, the other week, where we just were sliding and sliding and sliding, and now if we need to take distributions, oh no, we're down a considerable amount of capital and we rerun that calculation, we might lose a couple years of income. So it's really important that we bake all of those things in, and that's why really conservative estimates are really important. So moving on to insurance. It's really important to evaluate your insurance coverages to ensure that all of your assets are protected. Most of your assets will usually be protected by what you know what to do by default, but sometimes there can be some holes in your armor, and we want to make sure that we patch those up. A plan will have a great reduction in probability of success if the assets are depleted from a lawsuit or an unexpected expense. It's kind of like that idea of the market crash that I just talked about. If we've got $1 million and we know that that's going to satisfy, that's for sure 95+% probability, we are feeling really good about that, and suddenly we have to spend $250. Now we're down to $750, and it's a much lower chance that we're going to be able to satisfy those needs with the same return. And in order to take on a bigger return, we need to take on more risk, which also is reducing our probability of success by a little bit. So it's important that if we can, we protect those assets to maintain the probability of success moving forward. So if you've got all your assets here, I just like to visualize it in a big circle. This is your whole pie. This is all of your stuff put together. You've got your house in there. You've got your investment accounts. You've got everything all bundled into here. A lot of people will be kind of in this situation where a good chunk of their assets are covered, but there's just some that slips out from underneath that coverage. Now, the problem with this is that all of those assets outside are vulnerable. Those can all get chewed away from creditors, from suitors, all those sorts of things. Like, they can take those assets away from you and now you can't use them anymore. If only the stuff that's under your insurance is what you need for your plan, that's fine. That's okay. If you don't want to spend the premiums, just understand the risk. And a lot of people will think that, well, that'll never happen to me. What am I going to get sued for? I'm just a guy. What's going to happen? You don't know what's going to happen on the road. You don't know what's going to happen at your home. As much as you think you have everything under control, if somebody slips and falls on your property, that's on your insurance, that's on your assets to pay for that a lot of the time. Especially if you're found liable for somebody having an accident on your property, that's you on the line for that. That's not their health insurance, that's going to be you. Same thing in a car accident. If you're found at fault, that's going to be you. And if the total amount goes over your protection, they're coming for your assets. So it's really important that we have this wonderful, this ceremonious, amazing relationship between our assets and our insurance, where everything's covered in some way, shape, or form. You can kind of imagine as ERISA protection as one of those forms of insurance. If your account is protected by ERISA, it's not going to be vulnerable to these lawsuits and to these claims. So there's a lot of different types of insurance that you can use that aren't necessarily the normal things that you think of. But when we get to the normal things, we've got a nice long list of different kinds of insurance that we want to make sure that we're up on. Our medical, obviously we want to make sure we have really good medical coverage, especially going into late term of life. Those things just become a higher chance that we're going to be dealing with those problems, and it's really important that we have that coverage. Long-term disability might be helpful for younger beneficiaries that you know, so if you know them, pass this information on, or even if you're still working and your income is really important to your plan. It's just really knowing what your needs are. Long-term care. We've talked about this a couple times. We brought it up. Long-term care expenses can get really, really high. And yes, some of you may have the assets to sustain that and be able to pay for that. But if you don't, or you want to preserve those assets for beneficiaries, this would be a really good place to have things like long-term care. Now, there are some riders that you can add to annuities if you have them, or there are some ways that you're able to convert some of your annuities to long-term care insurance. So that would be something, if you have old annuities sitting around that you don't know what to do with, call your company and see if they have any options for long-term care and how you could use that annuity for that. Life insurance. In late stage of life, there's not too much need for life insurance unless you've just got such a giant estate that now we're thinking about estate taxes. But with the exclusion being as high as it is, that's not really too much of a concern until it sunsets, if that happens. So we'll have to pay a little bit of attention to the election and what they decide to do with something like that. But for younger investors as well, it's important to have life insurance because they might be protecting the little bit of assets that they have, or they just want to provide some ease of mind for somebody dealing with their loss. That's something that can be really, really unfortunate. Is it's not just the loss of the person, it's also the loss of what the partner or family can do in the time that they're grieving. So it's important to be able to provide for those expenses as well, because you may end up drawing a lot of investment assets away while they take time off of work, or funeral costs, or anything really like that. That's when things like term life insurance can become really useful, is really just making sure that you give a moment to pause, because you don't want to make sure that you're just sprinting through all of this all the time, having to compartmentalize and forcing them to deal with something that they may not be equipped to deal with at the time. Homeowners insurance, also super important. Things like replacement costs, checking what your exclusions are, and just knowing where you're covered and where you're not, so that if you need supplemental insurance, you know where to buy it. Car insurance, we really just want to be maxing out everything on car insurance at this point. There's no reason not to have maximum liability, and making sure that underinsured and uninsured motorists, that is as high as possible, because that will be really important. And also checking your exclusions there as well. And then liability, especially something like an umbrella liability policy. This is something we talked about briefly before, but you want to make sure that if you have assets that stretch way beyond all your liability coverage in terms of your auto, your health, and homeowners, that you want to make sure that if you have extra assets that could be vulnerable to those sorts of things, a liability policy will be, umbrella liability policy will be what you want to step in. Once all the other liability coverages tap out, you want that umbrella liability that basically covers all areas like an umbrella. So once one maxes out, it can step in to take the rest of the fall. So a couple key takeaways is you want to just maximize your coverage on policies where you can. Yes. Yeah.
So banks have the advice.
Yes.
Tell us about the kind of insurance. So
They do have something somewhat similar, and it's called SIPC. So I forget exactly what that stands for. And I don't think it's quite the same amount of coverage. Do you remember how much that coverage is?
So,
Okay, yeah.
brokerage firms like Fidelity or Schwab, they'll go out and buy additional coverage with a multitude.
Yeah.
that's spreading money around the coverage.
No. Yeah, they will have plenty of coverage.
At the bank, you have FDIC, right?
Mhm.
And if there's a 250,000 per
Yeah.
account, and then 250,000 per beneficiary. Trust?
Right. Yeah, so it'll be per person, per individual at the institution. So one thing that we actually learned about kind of recently that we didn't know before is if you have a trust with a bank account at a bank, and you have multiple beneficiaries, each of those beneficiaries will count for FDIC coverage. So you'll get $250,000 of coverage for every beneficiary that's to that account. So if you have $1 million account with 4 beneficiaries, you'll get enough FDIC to cover the whole thing, because it's technically for the benefit of those 4 different people. So that's an interesting little tidbit that we learned not too long ago. Pretty helpful. So a couple key takeaways. Maximize your coverage on policies where it's reasonable. If it's not going to shoot your premiums so far through the roof that you can't afford it, it's pretty smart to put those extra dollars down and just to cover those things where you can, especially if you have significant areas of vulnerability. We don't want to have vulnerabilities. We want to be confident that even if we have to cover something ourselves, it's not going to really drag us down too far. Cover the remaining assets with an umbrella policy if that's feasible for you as well. So if you've got $2 million worth of assets, but all of your liability insurance is only going to cover up to $500,000 of that, you may want to add a $2 million umbrella policy to cover that $1.5 million shortfall. And that was also something that was interesting to learn, was that when they say a $2 million umbrella policy, they really mean $2 million minus what your other insurances will cover. And then that's where we'll step in and how much we'll pay. So something to keep in mind when you're shopping around is you're not shopping for the shortfall, you're shopping for the total of assets that you're hoping to be covered. And consider how life insurance could fit into your strategy, if it could at all. Obviously, at later stages of life insurance will get more expensive, but there may be an extenuating circumstance that you want to cover for, that you just want to pay out of pocket premiums for, rather than having a big pile of cash to pay for. So next up is estate planning. And this is one of those ones where, we don't talk about a lot of the complicated stuff, but we just want to really make sure that you've got the simple stuff down. Because when you don't have the simple stuff in place, that's when it can just turn into this complete mess after your passing. So making sure that you have a will, no matter what, even if it's not going to be the primary vehicle that says where assets are going to go, just make sure you've got your will written and kept away. You might be able to get away with a small estate affidavit that really can just help let you handle things without having all these trusts and not going through probate and all those things if you have a particularly small estate. Make sure that'll be kind of a catch-all for all your personal property, all your little things that you might have in your house, or if you have any decorative stuff, like things that just are not going to be appraised at large values. You can kind of use the will as a catch-all for all those little things and direct those to where you want them to go. Now, when our estates get bigger, or we want to get more particular with what we're doing, that's when trusts become incredibly important. Especially with a large estate, a trust will end up being more cost effective than letting it run through probate or just go through a will, because a lot of those expenses, when we talk about probate especially, those expenses can end up being like 5% of your assets. And that's a lot of money if we're talking about big numbers. And it also could just take a long time. So if it's years of paying those percentages, that can really add up. But especially if you want specific instructions. If we really want to make sure that assets pass in a super particular way, or there are specific barriers to access to the assets for certain beneficiaries, trusts are going to be really important. You can use what's called a spendthrift provision or a spendthrift trust that basically you can be as specific as you could possibly imagine. Anything you want to do. If you want to require them to be married before they get the money, you can do that. If you want to require them to go to college before they get the money, you can do that. Pretty much anything that you can imagine that's still legal, you can make a specific requirement for the beneficiaries to access the money in that trust. So that's very helpful. But of course, a couple things to keep in mind with trusts is how the assets are going to be handled after your death. So if assets remain in the trust and income is earned to the trust will pay its own tax rates. And those are quite high, higher than any individual rates. So if you've got income coming in, you're just going to have to understand that that's going to get eaten away by taxes pretty significantly. Now, if income passes straight out of the trust before sitting there for very long, as soon as it comes in, it goes right out to the beneficiaries. That's what we would call a conduit trust. Now, when that happens, that money does not get taxed at the trust rate, and it goes straight to the individual, and then the individual will pay their taxes on that. So if you think that you want to basically keep your assets held in one place, but give beneficiaries the benefit of income, that would be a really good way to do it, to not lose too much to taxes. So if you got income coming into the trust, if it stays there, it'll get taxed at trust rates. If it flows through like a conduit straight to your beneficiaries, it'll get taxed at the individual rates. Beneficiary designations are a really easy way to very quickly get some of your estate planning done. Insurance policies, obviously, where's the death benefit going to go? You also have your IRAs, 401ks, and anything like that. You want to make sure that you have your beneficiary designations set up very specifically with your financial institutions so that upon your death, they can roll over the IRA and start taking that money immediately if that's what you want to have happen. A transfer on death designation is also very helpful for things like bank accounts, individual investment brokerage accounts, and even home home titles and stuff like that, where you can have it so that immediately upon your death, same as a IRA beneficiary designation or something like that, it will go straight to that person, avoiding probate, avoiding any other process, and just going straight to that person's hands. So, yeah, sorry?
Just if you say the beneficiary of the bank account and everything is there.
Yeah, so if you have a transfer on death designation on the account, that'll be a particular thing. Sometimes it's payable on death, sometimes it's transfer on death, but you can ask your institution about that. And basically that'll just say, when I pass, this person will immediately get access or just have this re-registered into their own name.
However, have you with the trust, both of them, or just trust?
So it is definitely important to have a power of attorney for things being able to be handled. It's not necessarily a requirement in all instances, but it's really helpful for if there is anything that needs to happen basically before the trustee starts acting. So if we need, for example, to collect, like, let's say you pass and whatever financial institution holds an IRA or some other asset that's going to get transferred to the trust, they might need some documentation, but the person that they're authorized to speak to has passed. So that would be an important place to have a power of attorney or a durable power of attorney, so that that person can step in and basically cross all the T's, dot all the I's, and make sure all the information is present so that the assets can then be transferred. That is, those are really helpful documents to really just help for shortfalls or any miscommunication errors that happen. Because if you don't have somebody who's authorized to speak on behalf of that person, that can be really unfortunate. So if you become incapacitated, it's really important to have those things in place. Yes. Yeah.
Do they pay tax?
No, that'll be, if it's a qualified nonprofit, 501c, all that good stuff, if it goes there, nobody's got to worry about anything, and then they'll just handle it all tax-free.
Kind of bad, but that's like that. Problem with that is that's the way to go. You can't get that money.
No, so, right. So the power of attorney is what will step in when you're still alive, but you're incapacitated. No, unless you have somebody who can step in on your behalf, then there's no way to access those funds, correct. With the TOD, that's strictly upon your passing that those assets will go over. Yeah. And then since we were just talking about them, our power of attorney documents are really helpful. A medical power of attorney or living will, just to make sure that any wishes that you have about how you're going to be treated when you're in a position where you can't say for yourself, like just making sure that the treatments that you want to be treated with are the ones that are chosen, and not just whatever the professionals think or your family thinks, because you may just have different ideas. Some people don't want to be hooked up to so many machines, and that's totally fine, but it's important that there's a document that states that, so that if you end up in that position, there's something for people to follow, even though it seems that sometimes those will get overridden anyway. Yes.
Advanced healthcare record.
Yeah, that's kind of similar names for all the same documents, living will, medical power of attorney. There are some small differences in some of those documents. So it's kind of always safe practice to just, like, any of them that are available, to get yourself an advanced healthcare directive, get yourself a medical power of attorney, but they can be somewhat interchangeable in a lot of states. But I would definitely just look at having all of the available things that you can to make sure that there's some sort of directive for the people that are taking care of you. Otherwise, you don't know if your wishes are going to be followed. Financial and legal, for obvious reasons, we want to have these. We want to make sure that we have somebody that can step in if we're incapacitated and can either pay for our bills or meet with our advisors to let them know that things are changing. We've been in a couple situations where, you know, somebody is going closer and closer towards that edge of not being able to do things for themselves or be competent, I guess is the word that is used a lot. And if there's no document set up and then they finally cross that line, who can we take any instructions from? Nobody really, until something's figured out. We can't take instructions from anybody. So a lot of the times things can just sit in limbo while you're incapacitated, because we have to pretty much wait until your death to do anything. We can't confirm any instructions. We can't ask anybody. We can't even speak to anybody unless we have the proper documents on file. So it's very important to have your power of attorneys. It's very important to also have trusted contacts on accounts and things like that, and third-party authorizations for information, so that we're able to reach out to somebody if we can't get a hold of you in a lot of different instances, just to make sure either you're doing okay or to see what the situation is and figure out what we need to do quickly. So when courts get involved, we just don't like it. Like I was mentioning before, if you don't have a lot of these documents in place, if you don't have trusts, if you don't have beneficiary designations, instead of assets going straight to your beneficiaries, as we would prefer, what they end up doing is they end up going through a probate court. And in California, it's not what we want. So we want our assets to go straight from your estate to your beneficiaries, even if they have to hang out in a trust for a while. We want it to go directly to our beneficiaries. We don't want to go through the court. We don't want to wait years and years for our assets to come out. We don't want to pay all the fees that they're going to charge us. In fact, we'll talk about this right now. In California, it typically takes 12 to 18 months for probate to finalize. 12 to 18 months. Versus if you've got a transfer on death or a beneficiary designation, we could get that processed and completed within weeks to a couple months probably. Versus 12 to 18 months, over a year for your assets to finally come out of probate and get to the places they need to be. But what if there's more immediate needs than that? What if we need to satisfy something within 12 months, within 6 months, within 3 months? And it can get very expensive. The fees are based on gross assets, not net assets, gross assets. If you've got liabilities, it doesn't matter. They don't subtract that from the number to calculate your fee. They calculate it on all the assets that sit in your estate. And then they decide how to pay all the creditors, how to pay everybody off, and finally move forward. And one of the most unfortunate things is that probate proceedings are public proceedings. All of this information is out there. They can see exactly where everything goes. So if you've got a family that, you know, some people have a bigger idea of what they think they deserve versus what you would be giving them or what the court would decide to give them. All of that gets to be right out there in the public eye. Everybody gets to see who gets what, and that could create some risks for people. You never know. When people get a lot of money and other people know about it, they tend to really set their sights on those people, whether that's violently or whether that's just emotionally manipulative. There's a lot of things that happen when people understand that people have a lot of new money. People always want to get their hands in the pot. And assets can just plainly be distributed in a way that you wouldn't want. They might just go to different places that you're not wanting to go because that's what the court decided and you didn't have documents in place because you didn't prepare. Yes.
Have a beneficiary, and that's only transferable upon death.
Mhm.
But if you have a POA, financial POA, can that person have access to that bank account when needed?
So it depends on the kind of POA that it is. If we're talking about just a regular durable power of attorney, nothing special, yeah, they'll be able to access it now if they wanted to. Now, if it's a spring forward power of attorney, which is generally what we tend to recommend, that will be waiting for a specific event or action to trigger their ability to access it. So a lot of the times, if you don't want to give somebody access to your assets now, but you want to give them the ability to if you become incapacitated, that's what a spring forward durable power of attorney will do. Now, just to clarify a couple terms in there, when we have a power of attorney, just period, no other extra words, just a power of attorney, that's the access for them to act on your behalf. But if it's not durable, that means that it will not continue through your incapacitation. If it's durable, that means it withstands the attack of you being incapacitated, and they can still act on your behalf while you're unconscious, in a coma, whatever the deal is. They can still act for you. Now, if it's spring forward, that means that we're waiting for a particular event. So what we generally want is a spring forward durable, which means that it only will spring into action upon an event, usually incapacity, and it will be durable through that capacity. And then all power of attorneys will cease upon death. Yes.
Like, prior to terms of authority of different types of documents. I think and questions asked. Like, for example, my mother put her spouse as a beneficiary on an investment account at Merrill Lynch. Then they did their trust, living trust. She said, these assets are to go to my spouse, these assets are to go to my daughter, these assets are to go to XYZ. When she passed and they went to do the distribution, they said, oh, sorry, you don't need to me. You cannot have the account that your mother left to the trust because the beneficiary of that account has stopped.
Yeah, correct. So
Dated like 7 years ago. So is there not like, and then that had to go to probate.
right. Yeah, so this is another reason why you want to check on your designations and directions for all of your assets. But yes, account wise, it will always be the beneficiary designation on the account first, because that's what that institution has to follow. They can't follow any other instruction. If you have designated a beneficiary, that's where that's going to go, because that's what they have been told by you to follow.
Question was, and which was odd, because in that account that she listed in the trust was, let's say, account number ending in 58. But the documentation that they were presenting, that Maryland was presenting, that had the signature of her mother stating that her spouse is a beneficiary, was an account that ended in 10. It was not the same account number. And
Yeah.
so who's to say that it was the same account? When you ask Merrill Lynch, they say, oh, it was when Bank of America switched ownership or something of the accounts or whatever, the account numbers got updated.
Yeah.
And I said, well, then if the account numbers got updated, then there would be a new beneficiary designation for that account that has a new account number. What does that say is the beneficiary? And then they refused to produce the document showing that. They said, well, it doesn't matter. When the account was set up initially, under the old number, it stayed spouse.
Yeah. So in terms of identifying accounts, instead of using account numbers, which can be super helpful, the main thing to keep in mind is the registration of the account. So that'll usually stay consistent no matter what, because you'll basically have so-and-so's name, Roth IRA, or whatever the case may be. That'll be the registration of the account, and that's what we want to use as our identifier a lot of the time. Yeah. So that's, I don't know what the exact determination of that is, but generally it's like if you don't have the capacity to act for yourself as determined usually by a medical professional of some sort. So usually you'll have some sort of medical professional that'll see you and say, yeah, there's no way that this person can do anything for their own benefit. And then they'll sign a thing and present that. And then that gets taken to whoever's holding the power of attorneys. And then they make sure that that's all correct. And yeah, so usually that'll be determined by a medical professional. Yeah.
My mom was in the state, and we had to have a mental power of attorney.
Interesting. Okay. Yeah.
That it had a spring forward on it.
Right.
Doctors have.
Yeah.
Certain things here we fold it.
Right.
Change.
Right. Exactly. Yeah.
Different states have requirements to get us specific mental health.
Yeah, that's very interesting. I haven't heard of that specifically before. Yeah. Wow, that's really interesting. Yeah, of course. Yeah. That's really interesting. So moving forward, here's a couple of different examples of what we might want to be doing with our estate planning. You might be charitably conscious, you may be very charitably minded, and you want to give your assets. So direct out of an IRA is something that's really easy to do. It's called a qualified charitable distribution, or a QCD. Pretty much at any time, you can elect to just distribute your assets directly to a charity. You won't pay any taxes, it'll escape your estate, and you won't have to deal with that money ever again. You can throw it away. And one thing that you can also do is, if you have a very particular situation, I know there's some retirees who they've got their budget perfect, they like it exactly how it is with their Social Security and whatever, and then the RMDs come around and they go, this is going to bump me to the next tax bracket. I don't really want that to happen. I am comfortable exactly where I am. So if you really, really don't want the money coming out of your IRA, you can direct a QCD to fulfill your RMDs and have that go straight to the charity, not worry about it, not going to affect your taxes. Nothing's going to happen to you. You just keep living your life exactly as you've been living it. And oftentimes, if your IRA's invested pretty well, that's not going to draw down the balance too far, and you'll still be able to gift your IRA to whatever beneficiaries you want. So it's not going to be a charitable deduction because you're already avoiding the income tax of it coming out of the account. Yeah. So that's basically where the deduction would be just against the distribution. Things like charitable trusts, these, I remember we had a big, long conversation about how we thought a charitable remainder trust and things like that worked. But basically, you've got some charitable trusts that you can use as well if you want to do a couple different things at the same time. So you've got a charitable lead trust and you've got a charitable remainder trust. A charitable lead trust, when you put the assets in there, the first thing that they will do is contribute to the charity or pay money out to a charity, and then they can do what they want with those assets. Then after that, the remainder will go out to the beneficiaries or whoever you've got named, however you have that structured. Now, charitable remainder trust is a little bit different. Charitable remainder trust, you'll put your assets in there, and then they'll serve whatever purpose they need to serve during the life of the trust. And then when that has concluded, the assets will pass fully to the charity. One thing that we saw a bit after the Secure Act 2.0, I think it was, came out, and there weren't stretch IRAs available anymore for a lot of beneficiaries besides the eligible designated beneficiaries, whatever the super long terminology is now. But basically anybody but spouses couldn't get a stretch IRA. That was now reduced to the 10 years. So one little hack that people would do, which mathematically doesn't quite equate to the same thing, but they might have an IRA get distributed into a charitable remainder trust. Now, because it's hitting a charitable remainder trust and the charitable remainder trust doesn't pay any taxes, the IRA comes out tax-free. Now they give an income benefit to whatever beneficiary they would have left the IRA to, and say over their lifetime, stretch out these payments. And it basically is like RMDs over their lifetime from this other person's IRA. Now, the only part about that that makes it not quite the same is once you get to the end of that person's life, if there's any assets left over, they don't get to have them, their estate doesn't get to have them, they pass on to the charity. So if for some reason it's such a major concern that the beneficiary doesn't get all of these big taxable distributions over 10 years, and you would rather them have less of a tax bill than to just get all of the assets, maybe you could do something like this, but mathematically it just doesn't really end up working out too well because you just end up donating all those assets anyway to the charity. But if you want to accomplish two of the same things at the same time, that's where charitable remainder trusts and charitable lead trusts can be sort of useful. Now, in terms of inheritances, obviously, if you want to give money to a beneficiary, that's where estate planning comes in. That's kind of the whole point, is to manage your estate and where it goes. So things like family limited partnerships are a good way. If you have a family business, and maybe if you want to stay in control of the family business, but you want to start gifting that interest away, oftentimes what will happen is you'll create a family limited partnership with a whole bunch of limited partnership shares and a few general partnership shares that you will hold on to. So you hold on to the general partner shares, maintain control, but you're gifting these limited partnership shares over to your beneficiaries using the annual exclusion of like $16,000, $18,000, whatever it is right now. And you're gifting those away over your lifetime so that you don't have this big estate tax to pay at the end of the day, or any other big income tax things. If you're just gifting them a little bit at a time, much less of an impact all at once. Like we talked about earlier, beneficiaries, transfer on death designations, really important. If you have any insurance policies, investment accounts, IRAs, 401ks, anything that you can put a beneficiary on, even if that just ends up being your trust, go put it on there. That's one of the other things that probably would have been helpful in that situation, is if instead of having an individual person as a beneficiary of the retirement account, it went to the trust, then the trust would designate where it went to after that. That would be kind of the structure that we're looking for. Yeah, so it's kind of the structure that we're looking for is if you have that trust, everything gets left to there, and then it directs where you want it to go out if you want the trust to do all the direction. But if you feel comfortable with assets just going straight to beneficiaries, just beneficiary designations on those individual accounts are just fine. Revocable living trust, also something good to have where just you can take assets in and out. It's not going to be a problem for you to take them in and out, but they'll still be included in your estate. So if you have estate tax planning problems, it's not the most useful vehicle in the world. But if you're just kind of using it as an organizational tool for your own and a directional tool for your own estate, super great because we can keep that open during your life. You can put assets in, you can take them out with no consequence, and then you can write in all your instructions. And then once you die, it'll turn irrevocable. All the assets will be in there, and then they'll be distributed as you want. Wills, like I mentioned before, it's just a good catch-all thing. We just want to make sure that we're getting all the assets. So if you kind of mention any leftover things in your home or just any other personal property, that's a really good place to direct that, is from your will. Special needs trusts are useful as well. If you have a beneficiary that gets government assistance or anything else of that sort, special needs trust can be constructed in a way that doesn't harm their qualifications for that. So if they're getting any federal aid or anything of that sort, basically a special needs trust will be formulated so that it only pays for necessary expenses and doesn't give any extra income to the beneficiary, and is really, it's really managed for that purpose so that it doesn't end up affecting any of their federal benefits or anything else that they might be receiving. Yes. Mhm.
It's being inherited after I pass, and if I give it to a trust instead of to her,
Right. So yeah, you should be able to do that. And if there's any concerns for that, if it's going to the trust that's for the benefit, that shouldn't be affecting anything.
tax on that.
So she won't. Well, if the assets go in, if there's gains to be harvested after once it transfers there, the trust will probably pay the taxes on those. But then obviously as it gets paid out, she'll probably pay a little bit of income tax on that. But if it gets transferred to the trust, she's not going to have a tax consequence. The trust will have, if there are any, if there's any other taxes to be paid, the trust will handle those for her and then pay out for her benefit. So asset protection is another one that you might want to be thinking about with estate planning. When you move assets to something like an irrevocable trust, that gets them out of your hands and it's no longer an asset that you can be sued for and get taken away from you in any sort of circumstance like that. So if you want to protect some assets, you might move them to an irrevocable trust, especially if it's not for your benefit, if it's for the benefit of other beneficiaries. And now we call that arm's length. It's now outside of your hands, being managed by somebody else, by a trustee. Then those get out of your estate. They're not part of what can get taken away from you. Prenuptial agreements, we know about them, we've heard about them, tell your kids about them, recommend them every day of the week. Even though judges can decide to overturn them in some circumstances, it's still a really good baseline to have, where if you have assets, and it's just important to understand where we're splitting them up and understand who really has ownership of what going in. Yes. Yeah.
So if you have a living trust and it's termed irrevocable, but the people managing the trust are the people who are living in the assets into the trust,
Right.
dies, it should stay irrevocable, right? Because
Right.
they told me that, no, actually, the trust is now revocable because the one spouse died and the other one can do whatever they want.
Interesting. Yeah, this is, yeah.
Trust, usually if you're both in a trust, there's an outside trustee. And if they let me live in the house, that trustee is.
Oh, it wasn't set that way.
Yeah. So
I'll forget it.
yeah, if the grantor is the trustee, that would end up being like they've got hands in the they got hands in the pot, so that's revocable, right? Yeah.
Separate, you have to give up the asset.
Yeah.
Trust.
Yeah, that's, they even like did a quick claim on the house, and they put it in the trust, but the people managing the trust wasn't their themselves.
Yeah, it sounds like,
I need to
doing a quick claim, you'd have to change the title of the house to the irrevocable trust.
Yeah.
In which somebody else has a trustee.
That was them. I think I'll bring everything and make it ready.
Okay. So other things, including like your homestead exemption, just a little bit of protection that you'll get on your personal residence just for living there. Don't remember. Do you remember what the amount is now?
It's as high as 650.
Okay. Yeah.
How do you
Sure.
do that?
That's just something that you just
Go to
just
the
kind of,
board's office.
yeah. Okay. Yeah.
that's one of the only things you can do after the fact. So normally you can't go buy insurance after you got in a wreck, right? But you can go back and homestead your home, after you're in fear of being sued.
If, your home is in the bus, so instead of.
Yes. A revocable trust.
And then the last thing that we have here, as well as something that's common, it's not necessarily an estate planning thing, but it does fall under the category of asset protection, which is just a limited liability corporation. General partnerships, sole proprietorships and stuff like that, they don't have nearly the same amount of liability protection. If you've got a limited liability corporation, it's really it's you are only liable for your own mistakes, really, as one of the business owners. Is if somebody else gets sued, if somebody else that's not you gets into problems, you don't have to foot the bill for that. Whereas some other business structures that are a little bit more, they're a little bit more flowy, they're not so clear cut. You can be responsible for some of that if they're not able to handle their own debt. Yes.
Have a limited liability company and then you put a trust in it, or vice versa? Or
Vice versa is generally how people are going to do that. You'll have your trust and you'll put LLCs within that. Yeah. So after that, we've got the tax diagnostic. With taxes, there's not, this is a difficult one because you get a lot of people who come up and they go like, I got all these stocks and I got all these gains. How can I avoid that? And I just gotta look at them and go, there's not really anything that we can do here. So there's not anything that you're gonna do to avoid your taxes. You're not gonna be able to get away from the government, but there are some things that we can do to just make it either a little less painful or a little bit more efficient moving forward. Tax advantaged investments can be helpful if you just really don't want to feel a lot of the repercussions of getting more income and paying taxes. Things like municipal bonds, other tax advantaged investments can be a way for you to generate income, have it be extra, and just not really think about it because it doesn't add to anything on your tax return. It doesn't generate any more work for you to do. Now, one of the conversations that we have a lot that I've done a decent amount of research into is mutual funds versus ETFs. There's actually some tax benefits to using ETFs versus mutual funds. And there's a couple different places that we would want to use each product if we're just simply evaluating them on their own. We're not worrying about what kind of investment it is. We're just going to assume it's some kind of investment, probably a stock fund that has capital gains, that earns dividends. But with a mutual fund, essentially what happens is they're always going to pay out what are called capital gains distributions. When they have a position within the fund and they have it at a gain, say they make 20%, 50%, and then they sell that in order to buy something else, a mutual fund kind of works like a pass-through business vehicle where you as a small owner, when there are gains inside the mutual fund, those are going to get passed out to you and you're going to pay taxes on that. You'll get a little distribution and then it'll land in your account. Whether you have it paid a cash or reinvest is up to you, but you'll get this distribution, it'll hit your account, and now you'll have to pay income taxes on that distribution. Now with an ETF, they do things a little bit differently. Instead of buying and selling the assets within the fund, what they end up doing is they end up trading them back and forth with authorized participants in the market. Those are the people that help them create their funds, and it's also the people who end up providing all the stocks to go inside. So oftentimes, instead of the ETF going and buying the stocks to put in their portfolio, they'll create the shares of the ETF and trade them with somebody who already owns this giant block of stocks for the stock. So they'll trade their ETF shares for the stock shares. Generally, those authorized participants have the ability, they're in the business of going and buying big blocks of stocks for the best prices. That's where they make a lot of their money. They buy and sell giant pieces of stocks and bonds. So those authorized participants will take that job on, and then instead of buying or selling themselves, the ETF will simply trade back and forth ETF shares and stocks. So if they want to have Apple, they get their authorized participant to come over, they generate a whole bunch of ETF shares, and they go, we'll give you these shares that will be proportionally equal to all the Apple stock you're going to give me. And then they'll take the Apple stock and they'll put it in. And because it's an exchange and there was no sale, there's no tax consequences. Nothing happened. There's no sale, so there's no money to pay taxes on. And now we're holding on to all this Apple. It appreciates, it appreciates. It was $100, now it's $200. We've got all of this gain. We've appreciated by 100%. And if they were to sell those shares in the open market, huge tax liability. But instead, what they might do is reach out to their authorized participant and go, look, we don't want to hold this Apple anymore, but we are interested in holding this other company, Google. So can you go get me a whole bunch of Google shares and then we'll trade. And so then the authorized participant goes out and they do their best to buy at the absolute best price that they can for Google. They come back over to the ETF and they go, give me your Apple shares and I'll give you the Google shares. Wonderful. Now they've made an exchange. Again, no sale. Again, no taxes. And then if the authorized participant wants to give their ETF shares back for some stock, they can do that as well. Now they have no commitment to the ETF anymore. Versus with the mutual fund, that doesn't happen. It's purchases and sales. So all of that gets transferred out to you. But if you have an ETF, you'll never feel that. So for the most part, this really matters in things like growth funds. Dividends are a little different because they'll always get paid out either way. Capital gains, though, they only get paid out through mutual funds. So if you're holding something like a big index fund or a growth fund, like T. Rowe Price has a bunch of really good growth funds, maybe a Vanguard growth fund or something like that. If you have it in an account where you're liable to pay the taxes now, pick the ETF version because they won't give you capital gains distributions. But if you hold it in an IRA, it doesn't really matter because we're deferring the capital gains anyway.
The least efficient would be have a non-IRA with a bunch of stocks of trading, right?
With mutual funds, yes.
Well, let's say you have a brokerage account that you have somebody managing individual stocks. If they're buying and selling without consideration.
Right.
You're going to pay tax. And the other thing is, even if they don't charge you a ticket charge to buy or sell, there's spreads in there, but when they buy or sell a stock, there's money being made by somebody behind the scenes. So individual trading individual stocks, if you're going to do that a lot, do it in the retirement plan if you want to avoid taxes. Or on the outside, keep a gain and a loss, but then that it drops your cost basis. So the least efficient would be stocks and mutual funds outside of an IRA because they're not tax efficient.
Correct. So we've got things like tax-deferred annuities. You may be familiar with some of those retirement plans and other tax-deferred investment vehicles like IRAs and 401ks. Obviously, contributions to these accounts are going to be, tax-deferred, but you've got to have your earned income in order to offset those. So if you're still working and you want to keep contributing to a 401k, go ahead and go for it. But the other thing you may consider is something like a Roth account. And these are particularly useful for younger investors as well. So if you've got some beneficiaries or some kids, grandkids that haven't really started their investing journey yet, a Roth IRA would be a great place to start. Or if they have a company with a 401k and they have a Roth option, that would be good as well. And the reason for that is Roth accounts really, really are helpful if we've got a lot of time because we get to take advantage of stock market returns. With a regular IRA or a 401k, we deduct the money going in. We don't pay any taxes on it. Say I make $100,000 and I contribute let's just round the number up and say 25. So now I get taxed as if I only make $75,000. Now that 25 can grow as much as it wants. We're not paying any taxes on it yet until it comes out. Now, whatever money I'm making at the time when the money's coming out, this is going to add on top of that. So if I'm now down to say I'm making $50,000 at that time, and now if I pull out $25,000, that's going to pop me back up to the 75 and I'll get taxed like that again. Yes?
It's take out the principal from the Roth account.
Yes. Principal can come out of a Roth account at any point. Contributions always, you have to be a certain age for the earnings. Principal can always come out. Contributions can always come out at any time of a Roth account. Yes. Yeah, so the institution should be keeping track, but I would also probably be keeping track yourself so that you can argue, I've made this many in contributions, but it will be in there somewhere. But I don't ever like trusting them to do all that work for me, especially if you're at any point where you've transferred between a couple different places, that communication can get lost very easily. Yes. Yes.
I say, not go high. Conversion costs approval of 401 to try to qualify for it. Why do you have a tax benefit?
Unless you think taxes are going up in the future, or you're having more income or rate that's going to go up, I wouldn't convert just if
I'm so curious.
federally, but not state yet. So that's where it becomes a personal issue. If you're convinced tax rates are going up, we all agree they will, but then they might not. Who knows? But if you're assuming that, then sure, if you have a low income here, it's a good idea to convert it to your account.
Because most people don't have it, start taking it.
Yeah, exactly. Yeah, very good point. Some people convert when they first retire, before they take Social Security, to reduce the size of their pension or their 401k. So then what they pull out is a little bit smaller because they've already taken tax.
Yeah. So again, Roth accounts and conversions and stuff, that's always going to most strongly benefit people who've got time. People who've got time to ride that out and get more growth on the assets. Because what we want with a Roth account is we want as much growth as possible. If you've got a bunch of different types of accounts and you're not sure how to invest each one, and you've got a Roth, make that the riskiest possible one. And take on the most risk, most stock funds, throw it all into an S&P index fund if it makes sense in your plan, because we want the most growth possible in a Roth account. Because by the time we go to take the earnings out, we're not going to pay any taxes at all. Versus in a regular IRA, if we grow it a ton, we're still going to pay ordinary income taxes, which are hefty. Like, especially if you've got a big account and you're taking out that money and you're paying ordinary income taxes, that hurts. That hurts a lot. So we would much rather either do the Roth IRA, Roth 401k, pay nothing at all, or at the very least, maybe have a regular brokerage account where we can take advantage of capital gains. That would be something that we'd want to do. Okay. Now, if we've got somebody who's just starting out and wants to create a very tax efficient investment portfolio, here's kind of an example of some of the ways that you could move. So each step in this illustration takes you up the stairway to tax efficient investing heaven, I suppose. Each of these steps is listed in order of importance, building from the foundation up. So you utilize the funds at the bottom first, and then build up from there as your dollars to invest and your experience grows. The first three steps remain liquid with limited or with no or limited taxation, good for emergencies, unemployment, or home purchases. Now, not listed here is one of the best tax efficient vehicles that you could possibly have, which is your HSA. Again, mostly favorable for those younger and obviously just for those working, but an HSA is pretty great because you get that triple tax-free in a sense. You get to put your dollars in tax-free, they get to grow tax-free, and then if you spend them on qualified expenses, you also get to spend them tax-free. And one of the great things about that is now you can buy a lot of HSA approved products on Amazon, just directly from Amazon, which is really nice. So if you connect your HSA bank or you have your HSA debit card, you can just go on there and go shopping, and anything that's approved, you can just get delivered straight to your door. Yes.
Get qualified to have an HSA.
So in order to have an HSA, you need to have two things. One, you need to be working. And secondly, you need a high deductible health insurance plan. I think I forget what the exact number is, but it's like a $1,600 or higher deductible or something like that, which I kind of laugh at because my deductible is at least 3 times that already. And so, a high deduct, but generally you'll see on your insurance plan, it'll say something like HDHP, and that's when you know for sure it's a high deductible health insurance plan. And then if you have that, you're qualified to open an HSA, and I think the contribution right now is like $38.50 or something like that per year, but steps up every year as we move forward. So starting all the way at the bottom, tax favored money market funds, super liquid. You're basically just getting some tax-free interest on your money just for holding it there. Probably be some, municipal bonds, but whatever those money market funds are doing, tax-free. And then you've got tax favored index or ETF income funds. So you might have your municipal bond funds, or you have a growth index fund where they're not trading back and forth very frequently. So an index ETF is actually incredibly tax efficient because usually there's not a lot of dividends. So if it's a growth index fund, there's not a lot of dividends, and it also doesn't pay out capital gains. So you can hold that in your brokerage account and not expect to pay any taxes simply for holding it, like you might with a mutual fund or a dividend ETF. Moving up again, tax managed growth funds, index or ETF funds, pretty much what I was just talking about. Tax deductible retirement accounts, obviously your contributions to IRAs, 401ks, etc. Personal residence can actually be a little bit of a tax savings as well for a lot of things that you put into it. You can increase your basis over time with money you spend on your personal residence so that by the time you go to sell, you've increased your basis with improvements. You've also increased your sale price, but you can get a lot of your money back tax-free from that, as well as writing off some of the interest. The interest deduction is you can write off interest if you're itemizing. You can write off the interest on up to $750,000 of home debt that was used to acquire the home. So we're not talking about home equity loans or any of those sorts of things. It's just what you spent to purchase it up to $750,000. And you also get an exemption for your personal residence when you sell at $250,000 per person worth of gain. You don't have to pay taxes on. So if you bought for $250,000, you sell for $500,000, you're in the clear. You don't have any taxes to pay. Then you've got your Roth accounts like we were just talking about, Roth IRAs, Roth 401ks, Roth tax sheltered annuities. You've got your tax deferred annuities, hopefully no load, low cost. If you really want to buy these products, you want them to be super inexpensive, not trying to sell you on a whole bunch of different riders that are going to cost you a crazy amount of premium or anything like that. And then you've got stuff like commercial real estate and personal businesses and all that sort of stuff. Now, converting, we were just talking about it, but converting your existing IRA to a Roth IRA. There are a couple reasons why you might want to, and there are a couple reasons why you may not want to. So let's talk about why you would. If you retired and you're in a lower tax bracket, you may consider converting, but usually you'd want to do this if you're expecting that the assets are going to stay and you're going to give them to somebody else later. Usually the time that I would recommend that is if you retire and now you're in a lower tax bracket, well, you want to give this Roth to some, or you want to give this IRA to somebody, that would be a great time to start converting and paying the taxes at a lower tax bracket so that hopefully now when your beneficiary receives it tax-free, here's a bunch of money from me and they don't have to worry about it at all. You retired later in the year and you can defer current income, deferred compensation, or defer pension until the following year. So if you're at a position where you've earned a decent chunk of your income, but you can decide to take some of that later, you can take it in the next year. You might be able to fill in that amount between what you would normally earn every year and what you've earned now. That extra amount, we could say, we're going to go ahead and convert that because that's what I'm already planned for. That's what I'm already ready to spend the tax dollars on. And now we can do a little bit of that conversion ahead of time. And like I was mentioning, if you want to pay the conversion taxes for the benefit of your future beneficiaries, which is most of the time that this is going to be helpful anyway, this would be a great opportunity to convert to a Roth, as if you want to pay the taxes for them as your gift. And if your future income is going to be higher, or you are completely convinced that tax rates are just going to shoot through the roof, sure. Go ahead and convert to your Roth now and take advantage of that growth potential, the tax-free earnings that we can get. Now, there's a couple reasons you might not want to convert to a Roth. You might get moved up to a higher tax bracket by converting. You may just be on that edge. You might be ready to get pushed over to the next tax bracket. And if you take this income, it's going to push you up there and you're going to have some extra dollars to pay. You may not be ready to pay the taxes. Because one thing that's very important is you can't just say, I'm going to take this money out, but I'm only going to convert a little bit of it. You got to move the conversion over to the other account because it's not a contribution. You're not taking it out, letting it sit in your hands, and now making an extra big contribution. A conversion is a special kind of transfer from one account to another. It needs to go direct from one account to the other, and you need to convert the entire amount. If you don't have the money set aside and you take the money out, if you convert this money over and now you don't have any free cash to pay the taxes for, what are we going to do? We need to make sure that we're able to pay this tax liability because we can't take money from the conversion to pay the taxes on the conversion. We need to pay it out of pocket. So if your tax rates are not less than they were when you contributed, then it just wouldn't really make any sense to convert to a Roth because you're going to pay higher taxes than what you were avoiding anyway. So what would be the point? Sure. So after you convert, I believe it's going to be, is it going to be the same rules as a regular? Yeah, so it's going to be the same rules as a regular Roth IRA. The contributions or conversions will need to stay in the account for 5 years at a minimum, and then you'll need to hit the age requirement 59 and a half. But I think, do you know if those contributions can come out?
You know, if you were of age to do a normal requirement distribution, or if you're over 65 or 70, I'm gonna guess if there is. There you go.
Right, yeah, there's that.
Yeah,
Okay, yeah.
yeah, just check, like Nash said, on your income taxes, whether or not sold Medicare or I do a full estimate first.
Okay, so let's talk a little bit about the things that we can do on the personal residence. Most of this will be what I already mentioned, but some loan points on the first mortgage you can deduct. Mortgage interest is deductible for most homeowners on the first $750,000 of acquisition costs. Let's not get that confused with home equity loans or anything else like that. You want to make sure this is on your acquisition mortgage, and there may be a couple special circumstances, but basically just think what money you use to purchase up to $750,000 of a loan, you can write off the interest on that. Property taxes are deductible within certain limits. So within California, that's up to $10,000, which would be the SALT tax, state and local income taxes. Improvements increase your basis. So if you're putting improvements into your home, not maintenance, but actually improving the quality of your home, improving the value of your home, keep those receipts because that can add up your basis for when you go to sell. You want to make sure that if you put a bunch of improvements in, you want to make sure you keep track of that because then if you get to the end of it and they only know that your basis is what you paid for it, nobody's going to say, we'll give you an allowance for all that money you put in. You're going to want to keep track of that. Keep your receipts and make sure you know how much you've put in to increase the basis of your home. Now, the exclusion that I mentioned, that's the Section 121 capital gain exclusion. You can have up to $250,000 of gain excluded as an individual, or if you own it joint, you can exclude up to $500,000 if you're legally married, yes. Now, there's two tests that you're going to have to satisfy in order for this to be true. One is the ownership test. That's pretty obvious. You have to actually own the house. But secondly is the use test. Out of the last 5 years, you will have lived in it for at least 2. That could be last 2 years I've lived in it. Great, we're satisfied. That could be the first year and the 5th year, satisfied. It could be any combination of those. As long as you've lived in it for 2 of the last 5 years, then it qualifies as your personal residence for the purposes of the Section 121 capital gain exclusion, and you can exclude capital gain when you sell. And now, oh, yes.
That 500,000, but you had to look at 7. But when you're doing this going 200, you don't get 200,000. You don't get 700,000. If your house doesn't sell for that much, if your gain on it wasn't 700,000, if your basis doesn't really matter.
Yeah, pretty much. Yeah, exactly. Right. Yeah, the whole point of the improvements is you want to hope that you bring the value up and hope that it appreciates more than it would otherwise. Right.
Adding on to that 500,000.
Yeah. Yeah, exactly. So do the improvements for yourself. Don't worry too much about the tax benefits of them, but it's important to keep track so that you can have them if they do become a factor.
Sell and buy a house, the same property tax for the same value or less. But you had lost money, so you don't buy a bigger house with extra money. keep the property tax.
And so then the one last thing that we can make sure that we know about, and this is applicable to a lot of other types of assets, but a step up in basis after death. When you die and you pass this on to the next person, their basis will be the fair market value at the time of the death. So that's one thing to keep in mind as well. That's why we like those transfer on death, payable on death, on things that have capital gains, because as soon as that asset is inherited, and only inherited, not gifted, as soon as it's inherited, that basis will step up to the fair market value on the date of the death.
That's not just your.
Yes, your investments as well. There's a lot of different types of assets that applies to, into brokerage accounts and trust accounts as well. Like when assets move in there, they'll step up. But basically any kind of asset that has capital gains, if it's inherited, that basis steps right up to the fair market value upon the date of the death.
Exception. Retirement,
Right.
hybrids.
So something that you may also be able to use is rental properties. There's a bunch of things that you can deduct with rental properties, loan points at purchase only, or the life of the loan, mortgage interest, property taxes, and there's more things that come in here, mostly because it's at this point you're running it for income, and these become expenses for a business, not just personal expenses. When they're expenses in order to generate income, it's a much different thing, and those have much more favorable tax treatment when it comes to costs. Things like management expenses, if you're paying a management company, that's a deductible expense. Maintenance costs become deductible, insurance premiums, and one of our favorite tools that we like to use in rental real estate, the 1031 exchange. If you have a rental property and you know that your basis is far below the current value, and you don't want to pay taxes on it, but you want to move properties, or you just, you're done with this one in particular, but you want to stay in real estate, you can sell your current property, purchase another property, and transfer your basis into it. Pay no taxes until the final day when you take your money out of real estate and convert it to cash. Now you have to be very particular about this because you've got time limits. I forget what the exact time limits are. Yeah, so they're for 1031.
Oh, we got 18 months.
6 months,
Yeah,
something like that.
yeah.
Yeah.
See, I'm to identify it.
Yeah, so you need to make sure that you identify and then close on that next property within a certain period of time to make sure that you still qualify for 1031. Otherwise, now you're going to owe all those capital gains taxes.
And you have to do the transaction through an authorized bank, right, where you never touch the money.
Exactly. And again, step up in basis, just like any other taxable assets. Okay. So we're just going to recap some of the things that we talked about, talk about it a little bit more. We went through our diagnostic review of our cash flow, insurance planning, legal documents, tax planning. And again, I really encourage you to take a look at something like this document that we provided to make sure that you really get down and can put all of your expenses in here and really understand everything. Make sure that, you understand what your expenses are now, what they're going to look like in the future, and make sure that you're able to plan for them accordingly. Make sure that you look over your insurances, identify any holes in your coverage so you know what there is to fix, especially with things like liability insurance. Make sure you're maxing out your liability and then adding the umbrella on top if we need it. Make sure you've got all your legal documents, your power of attorneys, advanced healthcare directives, all sorts of things. If you need to end up having a mental health power of attorney, if that's something that's important in whatever state you're planning, or any of these other specific things, really important to have those documents nailed down. And then your tax planning and investing, make sure that you know whether it's a good idea to do conversions, tax deductible contributions, all those things that we talked about. Making sure you're passing on some good information to your younger generations, like building up your cash reserves, maximizing the insurance, investing in liquid and tax-favored reserves so that they have money to fall back on, maximizing Roth contributions, making sure they have a will, even if there's almost no assets and they're just starting out, have a will. It's always better to have a will than to not have one. More things to share. Information about trusts, how that can help in all of these different circumstances like mixed marriages, loss of both spouses, Parents' life insurance proceeds, that's another thing that can be managed really well with a trust. Incapacity, making sure they've got durable power of attorneys for healthcare and financial and legal. Document storage and cybersecurity. Your kids will be pretty well up on this, but this will be something to really make sure everybody understands. Making sure you understand how to keep track of your digital storage, your hard copy storage, making sure you have trusted contacts on your brokerage accounts and IRA accounts and any other institution. Make sure you have good password storage. We love password managers. We use Dashlane in our office. Best purchase we've made ever. Making sure you have good protection for your ID and your passwords and that everything is strong. So with that, I hope you've all had a good time attending today and you've learned something. And if you've got any questions, please stick around and ask.